There is a document sitting in a filing cabinet somewhere with your family's future written on it. Most people have never read it. Many have never even seen it. And here is the part that shocks people the most. If what is written on that document contradicts your will, the document wins. Your will loses. Every time. This is not a loophole, and it is not a rare accident. This is settled American law, confirmed by the Supreme Court more than once, and it has already sent hundreds of millions of dollars to ex-spouses, estranged relatives, and people the deceased had not spoken to in 30 years. In every one of those cases, the family was certain the will had it covered. It did not. Today I am going to show you exactly which documents override your will, the 5 specific ways this goes wrong, and how to check and fix every one of them, usually in under an hour, usually for free. Before we start, if you are not subscribed to this channel, do that now and turn on the bell. What I do on this channel is find the things that quietly cost families money and explain them in plain English before the deadline passes and before the mistake becomes permanent. Mistake number 1. Believing your will controls your money. Your will only controls what lawyers call probate assets, furniture, personal belongings, a bank account with nothing else attached to it. Your will does not control your 401k. It does not control your IRA. It does not control your life insurance, your annuity, your pension, or any bank or brokerage account with a payable on death or transfer on death instruction attached to it. Those accounts pass by contract to whoever is named on the beneficiary form. For most American families, that is the majority of everything they own. So if your will says everything is split equally between your 3 children, but your IRA names only your oldest son gets the entire IRA. The other 2 get nothing from it, and they cannot successfully sue for it in most cases. How serious are the courts about this? In 2001, in Egelhoff versus Egelhoff, a man named his wife as beneficiary on his Boeing pension and life insurance. They divorced. He died a few weeks later without updating the forms. His own children argued that state law automatically canceled an ex-spouse's status after divorce. The Supreme Court disagreed, and the ex-wife kept the money. Then, in 2009, in Kennedy versus DuPont, a man named his wife as beneficiary in 1974, divorced her 20 years later, and his divorce papers specifically stated she gave up any claim to his savings plan. He never filed a new form. When he died, his daughter said the money should be hers. The Supreme Court ruled 9-0 against her. The plan had to pay the ex-wife because the ex-wife was the name on file. The divorce decree did not matter. The will did not matter. The form mattered. Mistake number 2. Leaving the form blank or naming only one person. If your beneficiary line is empty or the person you name died before you and you never named a backup, the account usually defaults into your estate. That sounds harmless. It is not. 3 things happen. First, the money goes through probate, which is public, slow, and expensive, and can tie up funds your family may need immediately. Second, the account loses what the IRS calls designated beneficiary status. Third, and this is the expensive part, the tax treatment collapses. When a retirement account lands in an estate rather than with a named human being, it often must be emptied within 5 years instead of being spread out, and every dollar comes out as taxable income. A family that could have stretched the tax bill over a decade can end up with a single, enormous tax year instead. Naming a primary beneficiary and no backup is the same trap with an extra step. If your primary passes away before you do, you are right back to the estate. There is also a small box on most forms that almost nobody reads. It says per stirpes or per capita. Per stirpes means if your daughter passes away before you, her share passes down to her children, your grandchildren. Per capita means her share gets divided among the other people you named and her children receive nothing. Most retirement accounts default to per capita unless you specifically check the other box. That single, unchecked box has disinherited more grandchildren than any bad will ever written. Mistake number 3. assuming your spouse is automatically protected, or assuming they are not. This one cuts both directions, and the rules are different depending on the account. A workplace 401k or pension governed by federal law automatically treats your current legal spouse as the beneficiary. If you want to name anyone else, including your own children from a previous marriage, your spouse generally has to sign a written waiver, usually notarized. People are frequently stunned to learn their children were never going to receive that account, no matter what the will said. An IRA works the opposite way. There is no federal spousal consent rule on an IRA. You can name anyone you like. The exception is the 9 community property states, which are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In those states, your spouse may have a legal claim to what was accumulated during the marriage, and the custodian will usually want spousal consent before you name someone else. So the exact same wish, "Leave this to my children," gets a completely different outcome depending on which account it is written on. Mistake number 4, naming the wrong kind of person. Naming a minor child or grandchild directly feels natural, and it creates a real problem. Insurance companies and retirement plans cannot pay money to a child. Instead, a court appoints someone to control those funds, with annual reports and court approval for withdrawals. And then the entire remaining balance is handed to that child outright at 18 or 21. A custodial account or a trust solves this. The beneficiary form alone does not. Naming a family member with a disability directly can be worse. Supplemental Security Income has a countable resource limit of $2,000 for an individual, and losing SSI often means losing Medicaid coverage along with it. A well-meant inheritance can wipe out benefits that took years to qualify for. The tools that avoid this are an ABLE account, which allows $20,000 in contributions in 2026 and now covers people whose disability began before age 46, and a properly drafted special needs trust. Both need to be set up before, not after. Mistake number 5, forgetting the house and forgetting to ask. Roughly 31 states plus Washington, D.C. now allow a transfer on death deed, sometimes called a beneficiary deed. You record it while you are alive, you keep full control and can change it any time, and the house passes directly to your named person without probate. A handful of other states, including Florida and Texas, use a similar enhanced life estate deed. If your state allows it and you have not done it, the family home is very likely headed to probate court. And on the Social Security side, one thing surviving spouses consistently get wrong. Survivor benefits are not switched on automatically in most cases. Somebody has to apply, and you cannot do it online. You call Social Security at 1-800-772-1213. The one-time death payment is $255, and it must be claimed within 2 years. Also know that Social Security is not payable for the month of death, so the payment that arrives the month after a death normally has to be returned. While we are here, there is a staggering amount of money nobody ever claimed. State unclaimed property programs are holding an estimated $70 billion and returned about $4.5 billion of it in a single recent year. The insurance industry's own policy locator tool has already connected families with more than $13 billion in life insurance and annuity benefits they did not know existed. You can search for free at missingmoney.com, at the NAIC website under Life Insurance Policy Locator, and at the Department of Labor's Retirement Savings Lost and Found for old workplace accounts. So here's what to actually do today. Make a list of every account with a beneficiary line: retirement accounts, life insurance, annuities, health savings accounts, bank accounts, brokerage accounts. Contact each one and ask for the current designation in writing. Read the actual name out loud. If it is an ex-spouse, someone who has passed away, or blank, that is your emergency. Name a primary and at least one backup on every single account, and decide on purpose whether you want per stirpes. If you have a 401k and want someone other than your spouse to inherit, get the signed waiver on file. If you have minor or disabled beneficiaries, use a custodian or a generic trust instead of naming them directly. Then, check whether your state allows a transfer on death deed for your home. One survey found only about a quarter of American adults even have a will. This video is about the paperwork that outranks it. I am not an attorney, and your state rules vary, so run the details past a professional. But the checking part costs nothing, and you can start it this afternoon. If this was useful, share it with the person in your family who handles the paperwork, because it is almost always one person, and it is almost always the one who assumes it is already handled. I will see you in the next one.